Hey guys, welcome back to our channel. Today we're going to try our best to help out all the beginners and people who are already on the way, but are really confused about what to do next, and explain how the stock market works. There are so many big words and doubts that come up when you think of investing in the stock market. People might have been telling you it's unsafe, and add that to huge expenses and small savings you're committing to. We don't blame you if you think that it's a risky prospect, but if done correctly, you could be aiming for huge expenses and savings. In all honesty, we would define stock market as a place which devours unsuspecting investors, but makes people who understand how everything works equally wealthy. The icing on the cake is that making your way through the workings of a stock market is quite easy to understand. Before we go any further, it is essential to know what a stock is. Also called a share, it is a financial token that signifies the ownership of a company in some proportion. Basically, if eBay had 100 shares and you bought one, technically you would be owing 1/100th of eBay. Realistically speaking, huge companies like eBay have millions of shares, but you could get to the point. When the value of the company increases, the price portion of the stock you own, rather the stock price, also increases. Stocks are generally of two types: common and preferred stocks, which are based on the voting rights of the shareholder. This means when you own a common stock, you have voting rights in the company board elections or participation in a merger. Preferred stocks are called such because they get added preferences when a company pays a dividend, which is a split of the profit of a company with the shareholder, and in other financial situations. We're not saying that stocks are a cakewalk, but these could be a reliable base for a basic investor. Now we face another question: why do companies sell stock? The answer is plainly before you: to gain money. Stocks allow a company to raise massive amounts of operating capital without any extra effort or product selling. The value of a company in the modern stock market is often based on its potential earnings down the line, which brings up the hope for small companies to earn $1 million or billions if investors think they have a potential to succeed in the future. Thus the entry of companies into the stock market. Of course, it's not the only place they can sell their shares. You might be trying to understand how companies list shares. Companies list shares by selling them through an initial public offering, or IPO, on an exchange. This changes a private business into a publicly traded business. IPOs can let the founders of the company to cash out their stakes, or just let the company raise money. Once the stocks are listed on an exchange, it means it's open to be traded by the public. Prices generally seem to fluctuate based on public opinion. However, careful analysis of data shows that the pattern of fluctuation is dependent on the company's earnings and operating ways. These are actually measurable quantities and can be expressed as a PE, or price-to-earnings ratio. We did talk about fluctuations in the share prices, but let us delve deeper into how or why these prices vary. The stock market is abuzz with millions of investors and individual traders who are capable of making their own choices based on what they feel about a company. It's a simple equation of these decisions and purchasing demands. Meaning, if more people buy, the price rises, and if more people are opting out on a particular company, the price falls. This can be seen in daily life examples too. Suppose you listed an item to sell on Amazon at a certain price, and you get several emails saying they want to buy the item as soon as possible. At this point, the advantageous choice would be raise the price of the item you listed until there's a single buyer who's willing to pay the highest price. Similarly, the opposite scenario would take place if you receive no buyers right at the beginning. You will keep on decreasing the price of your item until someone agrees to buy it at that low price. The only difference between this example and the stock market is that these price drops or increases are a result of not one, but millions of transactions which are all independent of another. For every stock purchase, there's always a buyer and a seller. Quite evidently, the more the number of buyers, the higher the price, and the more the number of sellers, the price drops down lower. A common term used is the bid-ask spread, which means the difference between the prices a seller is willing to sell a share for and a buyer is willing to pay to buy the share. In conclusion, higher the demand, higher is the stock price. When the stock market begins functioning, buyers and sellers were matched manually on trading floors. However, thanks to technology, trading systems now do the same thing much more quickly and efficiently. That creates the surprising pace at which stock prices rise and fall in the market. Let us move on to the biggest question most people face when they're confronted with the idea of investing in the stock market. Why would I do the same when I'm already earning 2 to 3% when I keep my savings in a bank? The answer is again really simple. When you invest in the right way, you can make a lot of profit. If you would have bought $1,000 of Amazon shares in 1997, you would have become a millionaire today. As long as you're making a profit of greater than 2 to 3%, it is much more beneficial to you when compared to the bank interest. Although the timeline might be long, it does give you amazing results. Now that you understand how the stock market works and why you should invest in stocks, the question of how do I proceed comes up. Well, the first thing you'll be needing is a trading account, which you can start with common providers, online trading services, or banking institutions. Once you've created an account, you need to figure out which company or multiple companies' stocks you're aiming to buy, which is the only hard part you need to correctly go through. Prices of a stock range from a few cents to thousands, so you have a variety of choices to choose from. We would suggest that you look into how well a company is performing, what it does, how much value does it have in the present-day situation, and expert suggestions about the company before you make a valuable purchase. At the end of the day, there is always a minimal risk factor, so you have to make sure not to make uninformed choices or invest a lot of money at once without considering other options. Well, that was all for today's video, where we covered how stock markets function and how you could take a tiny step towards investing. Of course, there are many technicalities and terms involved that we didn't go through, but for a beginner, you could just start with a small amount of money that you're okay with losing and take the jump. Maybe it could turn into millions in the coming years. Who knows? We would love to hear about what you think about making an informed investment in the comment section below. If you loved the video, do not forget to click on the like button and subscribe to our channel. We'll be back soon with another video, before you even realize that we were gone.